A very good evening, everybody. Welcome to the live webinar on Beyond Stocks, Discover Straits Times Index Futures. I'm Ming Hui from Phillip Nova, and speaking to us tonight will be Ms. Priyanka Sachdeva, Phillip Nova's very own Head of Market Insights. Before I pass the time to her, let me quickly remind everyone that if you have any questions throughout the course of the webinar, please feel free to drop them into the questions box and we will address them during the live Q&A session towards the end. And now, without further ado, over to you, Priyanka.
A very good evening, everyone. Just a second now. I am trying to share the window with you. And here we go. Okay, very good evening. Sorry for a little technical delay. I hope you are all able to see the screen, and thank you so much for taking in time and join us today. My name is Priyanka Sachdeva. I'm the head of market insights for Phillip Nova. My everyday job with Phillip is to see market movements, track different indices, see how macroeconomic movements or developments are basically impacting everyday sentiments of investors. Trade tariffs, announcements of monetary policy changes, uh, oil pricing, how the China data turns out, what is the global perspective. I study all of this to raise awareness of how, as an investor, you should be trading. But over the course of my tenure as an analyst, one thing that I have learned over time is that Singapore investors are incredibly aware of accessing the individual stocks available, right? But there is less awareness about the alternative forms of accessing Singapore markets through ETFs or through futures. So today, this webinar is dedicated at uh, talking about all of these alternate forms of accessing Singapore markets or gaining an exposure into Singapore stocks in a different way, a way which serves a different investor in a different objective, a different time frame, compared to just investing through a traditional form of stocks. We will be today looking at the STI, what it basically comprises of. We will understand how an investor should take an exposure on it. We will discuss the various alternative forms of investment, including ETFs and futures. And I will also be sharing a little bit on the Singapore market outlook that I have. So, but before we begin, under the MAS guidelines, it's important for me to share the disclaimer with you. So all this disclaimer is telling us is that we are MAS regulatory entry. In today's whatever I'm speaking is going to be just my personal views and about raising awareness in the markets. It is, if you do tend to invest into STI later, take your own research into account and probably talk to your financial advisor. Okay, so moving on, we will okay. All right, so the timing of today's webinar couldn't be more relevant. Like, despite the changing geopolitical background we have, the headwinds that we have, the tariffs, the continuous pressure of inflation, the higher rates that we are witnessing all across the globe, and the strong weight of USD, I still feel Singapore market is quietly winning. A return of 72.6%, which is in last 4.5 years, which actually makes up, if you translate it, makes up into a return of about annualized 15%, which is in itself a very winning streak altogether. Why Singapore is winning? Because of its banking sector, its attractive dividend yield, stable political environment. So there is a naturally an important question that if you're optimistic about Singapore economy, do you have to really pick up just an individual stock like DBS or UOB? Or there are smarter ways, more diversified ways of gaining an exposure into Singapore economy, which is already winning. Now, by end of this session, I do not intend that all of you should start looking or investing through only futures or STI futures or ETFs. But I definitely want that you as an investor should start exploring adding these instruments in your portfolio if you are just investing through stocks. I know that Singaporeans especially, they love investing through stocks. However, many of the investors, when they talk about investing through stocks, they somehow deviate their interest to probably US equities or access to China or Japan. And let's be honest, the very fact that because of the AI boom or the ease of trading these global markets, just the convenience to trade it through an app on your phone obviously is very enticing. But sometimes we look in the process of that, we overlook opportunities which are much closer to home. And when I say opportunities, I do not only mean stocks. There are many more alternatives that one can look at today. We have ETFs that give you exposure to the whole economy or even a particular sector. We have futures, which are like the leverage products that you can use, which allows you to invest through margin and probably increase your return on investment. We have alternatives like commodity futures and currency futures, which can give you hedging. So why only just individual stocks? Today is about STI futures. So let's understand what is an STI future. The STI isn't just an index. It's basically, I would say, the heartbeat of a Singapore economy. Like, so when you hear that STI is say risen by 1 or 2%, it doesn't mean that is we are talking about one company. That rise is about a cumulative rise in the all 30 stocks listed under STI. So
Sorry, Priyanka, can we have the slides in full screen mode, please?
okay, is it really small to see?
Yeah.
Okay, so I
Perfect,
just checked.
thank you.
Yeah, is this correct?
Yep, this is correct.
Okay,
Thank
I'm
you.
talking about hedging and short-term opportunities here. Yeah, okay. So this means there are, say, you can use all of this, and we were talking about STI futures, which is like a combined future that derives its value from 30 different listed companies. Okay, so I know a lot of people, a lot of investors gain access to the banking financials like household names like DBS, UOB, OCBC, which actually constitutes almost 50% of the STI. But there are other companies that are Singtel or Keppel or CapitaLand or Singapore Airlines. All of these are all winning streaks of Singapore, and together they offer a very good perspective or access to Singapore's economy. Now, how do we actually invest into Singapore market? Okay. Yes, today we will be discussing, most retailers think that it is just by buying individual shares. So that is only just the first or the traditional form of investment. But there are actually three different approaches of investing into Singapore economy. The second would be an STI ETF. Now it is like similar to an exchange, but it allows you to gain exposure in a diversified, slow kind of a mode. Okay, So say if you're just bullish about DBS, you will just invest into DBS. But if you want to invest into a Singapore economy and do it slow by slow and not just put in all your funds at one time, I think STI ETFs is an option. And the last one is the STI futures. Okay, so now these STI futures is like buying a basket of all these products together in one. And we'll be discussing this STI futures in detail today. So say instead of buying like one company, or you're like buying a basket of all 30 STI companies. Okay, so its value is derived by performance of all these countries, but this value is a weighted average because all of these companies have a different holding when it comes to the STI according to their market cap. Now, at the core of it, it means that you are buying a future, which is a leverage product. So there is one side of the coin, which means that you get to invest into the whole 30 stocks by just paying a margin payment. Okay. But that is a dual-ended sword kind of a thing, because it does, when it does improve your return on equity, it is also magnify losses. So yes, futures are a powerful tool, but they should be used responsibly, and that's exactly what I will be telling you today. And before we go ahead, let me tell you that all of these three products, the stocks, the STI, ETF, and the futures, they are not like competing with each other here in any ways. They serve different purposes. And today we will understand all of them in a deeper way. So let's understand what a future contract basically is. Say I want to invest into, like, a core future contract would simply mean that you agree to buy or sell something in a future date. So for example, like you walked into a property, a house, you liked it, you made an agreement with the seller, and you had an seller letter intent that on the following date the money will be transacted and the house will be transacted as well. Now this is the exactly basic idea behind any futures, but when we talk about STI, it's not an underlying asset, it's an index value. So what that means is that we trade the index value, and it is cash settled. There is no actual physical delivery of the stocks that happens at the end of the day. It is just the profit and loss that is directly settled on the day of the settlement. So let's understand this using an example. So say on day one, you entered into an STI future, which is like probably at 3,400, and the price goes up to 3,520, right? So you made 120 points on it, and as per the contracts, I say it's $5 per unit. So basically, you end up making a $600 profit on the end date, right? So you do not actually get the entire list of the 30 stocks. You just get this cash settlement done on the exchange. All right, so that means now how to understand. Let me try and make you understand how this future is different or beneficial or can be used against just using the traditional form of investing in stocks. Say you're a proud owner of DBS, and yes, it's constantly going up, but it can drop, right? So if it does drop and you are only holding the direct DBS stock, say it drops 5%, you end up making a 5% loss on your investment. So you invested $10,000 and there is a 5% drop in the price value. So you lost $500. Whereas if you invested using an ETF, now these ETFs are distributed, like it's a cumulative value of 30 stocks. So DBS weightage is say 30% in a banking ETF, right? So when DBS drops by 5%, the ETF price drops only by that marginal amount, which is 1.75, right? So you end up losing just 1.75% and not the entire 5%. Whereas if you have invested through a futures, right, there are two options. First, you are actually long on DBS and you short or hedged using a STI future. So while DBS drops 5% and you end up making a loss of 5% on your investment. But if you have equally hedged in STI future, which will gain because it will fall and you are short on it. So you will gain 1.27% on an STI future. So your net loss will be only 3.7%. Now there is another option that you already knew that it can go down, or you had a bearish view on it. You can simply short STI futures. Futures allow you to take a short position as well. In that case, you will only end up gaining 1.27%, which will be a simple profit. So all these three products, they have different features. They offer different payoffs. They have different characteristics or suit a different time frame of investment. And thus we are not kind of choosing between all three of them. We are kind of debating that all three of them should somehow be used to enhance the portfolios. Now, why I stress that we should, or any investor should be moving towards an futures trading or a derivatives trading or even ETFs, I would say. Most investors, especially the long stock only sort of investors, those who have exposures in stocks for long term, they always buy and hold even if the market falls. And let's be fair, market falls are not inevitable. Having said that, how you as an investor respond by using different alternative instruments and devise strategies to benefit out of them will actually tell you how your portfolio is going to perform. So if you're just a stock investor and market falls by 8%, so you will just hold, you will feel it's a paper loss, let's hold and wait, and let's see if there will be a price recovery in long term. So you are stuck, your capital is stuck, you are not making any profit, you're not realizing the loss as well, just holding, right? Even just holding something is also a sort of opportunity lost. Whereas, similarly, if you are an ETF investor, yes, you will still see a paper loss, although that paper loss could be a little lesser than 8% as well. You still stay invested. You can actually put in a little more money if you are a long-term perspective holder here. There are very limited options of shorting ETFs, so I will not get into that. But if you are a futures trader, actually, even when the market is falling and you somehow have bearish sentiments, you can actually profit using a future. So that's what it is about. It gives you opportunity to trade both sides. You never get stuck. Your capital is never 100% blocked. There is not an opportunity lost, because whichever way market is moving, you can take an exposure of your choice of side and you can still make money with it. And not just that, even if you have a portfolio which is long in stocks, you can use futures to hedge your positions if you feel markets are going to correct. So I would say, to sum up, that why as an investor you should look at trading futures. If you're already an investor and you own Singapore stocks, use futures to hedge. If you believe STI will eventually be stronger next to decades, yes, stay long, keep investing money slow. You can use ETFs as well. If you feel that market is going to correct, just simply short futures. It's very simple. It's a simple instrument you can use when markets are not in your favor. But to understand how to play with these products or how to devise strategies, there are certain macros that you should understand what are currently driving STI. Like, there are things that actually move a particular index. For me, I think these are the 4 pillars which I feel that every investor should be looking at. The first one is obviously the interest rates, monetary policy decisions. Of course, it is MAS who decides it, but it has a global perspective to it, which obviously impacts what MAS also does. So if there is a generally lower rates kind of a scenario, it's always beneficiary for STI because lower interest would mean businesses can borrow money at lower rates, and thus the returns on investments are higher. If usually corporate earnings or fundamentals which are currently operating in globe or in Singapore, I would say, are better, like corporate earnings are good, banks are doing a lot of good performances, there will be a lot of dividends, there are a lot of positive earnings, industries will improve, so that also has a positive impact on STI. Similarly, I would advise you to look at the global growth, or especially China. I would say, Singapore is a trading hub. It has relationships with globally every country, especially China. And in fact, China's growth story dictates the global trade altogether. So if those China's economy is performing well, automatically there is a positive sentiment spillover to the Singapore economy as well. So that's also beneficial for STI and vice versa. Third is like external sentiment or geopolitical, or trade tariffs, or probably like oil prices or the current Middle Eastern crisis that we are seeing. No matter how strong fundamentally our economy is, but when you have these kind of sore risk sentiments, or um, it's tend to make investors cautious. Wars are inflationary. Inflation projections change how markets perceive the return that stocks or indices should be giving, or markets should be giving. Right? It becomes more risky to invest in markets. So the expectation of returns also goes up. So all of these actually negatively impact STI. So whenever you are taking a position in STI futures, I would advise that as an investor, you should stay on top of all of these drivers. Okay, so this probably is why everybody of you tuned in my outlook on STI. Okay, this is a beautiful graph. I do not see any dips, like very occasional dips. That's probably the this one that you see between. I hope I can trigger and you guys can see. So this fall right here between March and April is when I think the trade tariffs were at the top of their boom. And yes, that's the kind of spillover I'm talking about. But if you look at the graph, it's so steady and so nicely surging. In fact, every month is like a higher highs and lower highs, which is a basic phenomena of a market which is trending upside. Okay. Now, if you look at the projection, Fibonacci projection that I did placed on this graph from the lowest point in 2025 to current recent high, the 100-day moving average is right at this 23.6 level, so which is 5,150. So I personally feel that even if because of some spillover or because of some geopolitical stress, markets does take a correction, this zone is going to be a wonderful support zone to re-enter markets. Okay, we have seen a lot of consolidation between 4800s and 5100s, and that's going to be the below mark for STI. And obviously, I feel the uptrend is continuing, and that would mean bulls will easily be eyeing a 6,000 mark for sure. Every indicator on this chart is still bullish for STI. And like I said, I strongly feel 6,000 could just be right the corner if everything goes well. But yeah, there can be a spillover from geopolitical issues if the war doesn't settle, if inflation persists for a very long time, if rate cuts could reverse actually the projections, and we might actually see a rate increase by the year end. So if that happens, still I would feel STI would be strongly supported above 5,000 level. It's a very good foundational consolidation here. So let's talk about what I feel are the macro scenarios that will ensure that STI stay bullish. Okay, so one of them is, say, Fed resumes rate cuts, which honestly I really think is debatable at this point. It's very dependent on how Middle Eastern issues will unfold, how inflation can be controlled, but I will not bet on this a lot anymore. Global trade ease tensions, of course, that is possible. It can happen tonight, day after, anytime. If that happens, it's gonna help the bullish run in STI. China growth improves, and that is very likely as well. China has been performing okay as per numbers. So yes, this can happen, and it will further support STI's bullish run. Strong bank earnings in Singapore. This one I can 100% assure you, the banks are performing really well, and I feel there is a very special thing about banking sector here in Singapore. Under MAS regulation, banks are supposed to render a lot of their profits to dividends. So when you own STI index ETFs or single stocks, or even through, you constantly get dividends. So this is going to continue, and thus it's going to support STI in a bullish pattern for sure. Foreign inflows, yes, it is a very big supporting factor because our government is stable, our markets are very steady and very transparent. It's a trust that Singapore has built world over, and not just. I'm not just talking about only banking stocks. I'm talking about everything. So yes, it's a very positive factor, and that will keep STI bullish. Lower oil prices, that is again debatable. Like I told, I do not know how Middle East crisis is going to unfold. It looks very messy as of now. Let's look at the flip side as well. So what could happen that could turn STI a little bearish? Okay, so there could be sharp global recession. Now, this is an outcome if the war continues. It's very expensive, it's very inflationary, and eventually the spillover gets to every economy. Okay, escalation in geopolitical conflict. US recession obviously is the first step. However, this doesn't recent numbers doesn't show so. The productivity in labor markets look stable and recovering. China slowdown, this also, I will say, these are just the things which can happen and turn bearish for STI. So keep an eye on all of these. And the fact is that no market goes up forever. And all of these things like US recession, China slowdown, trade wars, geopolitical escalation, higher rates, we have seen it all. It's not like the first time we're talking about it. So it can happen. And if that does happen, that's why we have STI futures where you can go short and use these futures available to you to run down an inverse exposure where you short the futures and still make money if markets are correcting. In my 20 years in financial markets, I can assure you one thing. Even professional investors or professional traders or fund managers, they cannot predict every single move that comes into markets. Okay, predicting it 100% is just not possible. They just Everyone who is successfully trading markets is just pricing a different scenario and reacting accordingly. So I'm not saying that stocks are not good or stocks should not. I'm not saying that. I'm just saying that be prepared for every scenario. If it's going long, take a perspective and invest into instruments that yield better returns when markets are positive or upswing. But when there is an uncertainty, when there is a bearish bias, when your sentiments are sore, when global markets are inching lower, use instruments like STI futures and gain exposures to make money even at correcting markets. That's what today is about. Okay, so we have spoken about the STI future. Let me briefly introduce some of the ETFs that are there. You can access Singapore markets by, especially the SPDR Straits Times Index ETF. why that is also a good way to do it. So some of the investors, they do not have research, they do not have access to individually analyzing stocks or risk appetite to take exposures on futures or technical know-how of doing it. So the easier way is to invest into and slow passive kind of an investment into ETFs. Like you can keep adding your money at every level you think that if there is a pullback, you can invest into ETFs, continuously doing that. It's very easy. You continuously get dividends from companies. You can small cap investments. There is it serves you the same purposes of holding a stock like capital appreciation or investing into the winners. You don't have to even use your individual research to pick up winners, right? It's automatically investing into the top 30 companies of Singapore. So all of this is a reason why one should be looking into investing ETFs, especially the STI ETFs. Okay, now these ETFs are a wonderful tool. Like it's not just like taking a bet on Singapore as a whole. Okay, you can actually trade different sort of thematic ETFs. Say if you are bullish about artificial intelligence, you can invest into an technology ETF. If you expect interest rates to fall, maybe REITs ETFs. Okay, say you are looking for a dividend income, you can invest into an ETF which is prone to give you more dividends. Okay, banking, of course, if you have been investing into direct stocks of DBS OCBC, you can still invest into banking sector resilience by investing into a financial sector ETF without picking a stock. So it gives you an thematic access to various kind of sectors, and you can choose whichever is growing or you feel will be growing and then invest into it. So just as a part of the recommendations, some of the ETFs that I personally feel are worth watching in 2026 would be obviously the first and the foremost, banking and financials. This doesn't even need an introduction. It's the strongest truth of Singapore economy. Like I told you, banks give very good dividends. So iEdge is one of those that you can look into it. Then if you are, want to benefit from REITs or interest rates eventually gradually declining, yes, it can be on hold for this year. I'm not debating that. But eventually they will come down. And if that happens, NICOM is one of the ETFs you can look for if you want to invest into REITs. There are obviously industry and infrastructure. The current scenario that we have seen, the uncertainty, it's always areas like defense, aviation, AI, regional investment, they're all going to benefit out of this. So CSOP iEdge MCI Singapore is another ETF that we would recommend you to see if you want to invest through a thematic form of investment. Okay, so to be a successful investor, I feel the most critical point is to stay aware and informed. It's to understand what can change, and if there is a change overnight, how do you read that headline? How do you interpret it? What will be the likely impact of it on your current portfolio, or current impact on STI, since we're talking about Singapore? And what could be your possible strategy? Okay, so let's just discuss a few of them. Say if Fed signals rate cuts this year, this would mean there will be an improved liquidity, the borrowing cost will come down, risk appetite will increase. So obviously it has a bullish impact on banks or REITs or property. So you can go long on STI futures, you can buy STI ETFs, you can even increase the exposure on Singapore equities as well. Say the next is probably oil surge above $100, right? Middle Eastern conflict doesn't settle, and the inflation fears rise, and there are higher business costs, the rates doesn't come down, there is a risk sentiment which is weakening, because of the uncertainty or ambiguity of how long the inflation fight will go on. Now this will have a very mixed kind of a reaction. Oil may benefit or energy stocks may benefit, but it can have impact on the other performing sectors, right? So instead of just staying put or not participating in the market, you can actually shift or reduce your equity exposure and probably put that same money into shorting an STI future. You can actually create a hedge here using the futures and benefit from market even when it is not performing very well. Okay, so say we start hearing that there are a lot of earnings which are coming positive or nice and it's bullish. So instead of buying just one single product because you do not want to put all your eggs in one basket, you can actually go long on STI futures, or you can just buy STI ETFs. As simple as that. It's just a simpler form of investment where you're not taking too much risk on one single stock. Okay, so let's. I want to try to be a little creative here. Let's see how many of you feel that what's going to happen. If you have time, just post in your replies of what happen if inflation persists or Fed rate increases rate in this year instead of, like we started the narrative of 2026 saying that Fed might have 2 rate cuts this year, but that perspective is completely changed because of the Middle Eastern war, and that's not going to happen anymore. And instead, there is a possibility that Fed may increase rates. So would you like to share what can happen on STI, or what can you do to using STI futures? Okay, so here's the answer. If does Fed rate increase the rates, right? That means, of course, because of the inflation, that means borrowing costs rises across the economy, global economy, including the Singapore. Okay, risk appetite weakens. Now, what does this mean? It will likely have an bearish impact on STI, right? So your possible strategies could be you reduce the equity exposure, you move to defensive stocks, right? Instead of the high beta or high speculative stocks, you reduce that exposure. And instead you short STI futures to hedge. You rotate into defensive stocks like healthcare and utilities and telecom. And you can even target those sector thematic ETFs which are like prone to high dividend paying sort of investments. And the things to watch would be obviously US data, Fed rate decision, your bond yields, your dollar strength, and of course the global risk environment. Now, we have discussed, like I've shared my opinion on traditional investment through shares and ETFs and futures. So obviously I feel that you must be thinking that how there has to be some curiosity within you to find that which one is the best option, right? And in fact, I get asked about this a lot when I talk about the alternative forms of investments, but the answer is none. They are simply different tools. They're the alternatives of accessing a market. None is better than other given a particular scenario. It just suits different investors, different type of investor, different risk appetites, and different scenarios or backdrop of financial markets. In fact, most of these should go hand in hand. If you ask my personal opinion, there will always be some shares you strongly want to invest in because of the higher conviction you have for them. There are other sectors that you feel positive, but you do not have research, so you find an access through using these ETFs. And there is definitely some time where everything is uncertain and you really feel there is a correction coming in. So the idea is to use futures to hedge your benefit, and especially because they give you access through a leverage sort of a medium. Okay, so it's not about choosing the best product out of it. It's about making a portfolio perform better by using all of this together. It's about making the best use of these different instruments available in the evolving backdrops. Backdrops keep changing. You cannot keep changing the kind of entire portfolio every time, especially in a scenario like today where headlines are flipping every other day. So you cannot be like flipping your entire portfolio holding in every 2 days. But yes, you can keep your core portfolios stable, and you can use uh, the rest of the amount, or into ETFs or STI futures and hedge, or probably you take a opposite position if you think correction is coming. So it's about learning how to use all of these different mediums of accessing Singapore economy and making the best out of it. They're complementary products, not competing products. And trust me, in my 2 decades of investments, preaching investments and doing them myself, all professional investors, they use a combination of all these three together to access Singapore economy. Okay, now yet another point. We are all talking about investment. So there are certain things which I feel you as an investor should also take care when you are doing. Okay, we are talking about futures and flexibility of leverage, but this leverage, the very product offering, comes with its own risk, and you need to have an understanding of the risk that it be. Leverage is like it can amplify your profit because you are trading on a margin payment. So it magnifies your losses also equally. So if your account does fall below a required margin and you have to give a margin call, you should have enough backup of funds to provide that margin calls to hold your positions. In my entire career, trust me, I've seen more investors lose not because they were on the wrong side of the market or wrong trade they have picked up. They they lose because they are incapable of managing risk. They didn't manage things like margin calls or having a buffer to pay overnight wild crazy price movement. They do not prepare that there could be volatility and extra funds could be needed for the unplanned things that could happen, and obviously the emotional free both fear and greed that comes into play when you are invested into market. So honestly, what I feel is that you cannot control the market, but you can control the risk that your investment brings along. So you're supposed to understand the products and protect your capital in every possible way so that you always have a next day to seek an opportunity. So the key to successful futures trading would be not about predicting every move correctly. That's just not possible. It's just managing the risk that comes along with having a portfolio and churning it and maintaining it and hedging it and using futures as an alternate investment form. So always have your soft losses, know your position size, never do the this dollar cost averaging, especially when you are trading futures. I mean, it works wonderfully with going long on stocks, but futures is a different product used for making speculative profits or hedging. And obviously have a trading plan to protect your capital first. Now, having said that and having shared all of this today, I have one clear message that I want to give every one of you tonight. You do not need to abandon stocks. You do not need to choose between three of them, ETFs, futures, or stocks. No, that's not the agenda here. The most successful investors always rely on a combination of these instruments. Stocks help you with great business, so your conviction-based investment go long. ETFs help you build diversified passive investment. So have something in the defensive kind of ETFs or something which gives you a regular dividend sort of ETF. STI futures help you respond quickly to overnight opportunities or hedge risk of market by going short, right? So it's an easier and a quick form of expressing the immediate change in your market views. And honestly, STI sits at the center of all three, and it gives you enough products to have an access to all of this in a combination. So whether you are investing just $500 or 50,000, today we in Phillip Nova, we offer you a broad spectrum of products to access Singapore markets, to trade in Singapore economy, to trade STI. And as an analyst, I would advise you to read every headline, make your views proper, stay aware, grow your understanding, whether it means buying a stock sometimes or investing in ETF or through STI futures, but keep yourself aware, keep yourself motivated, keep exploring, and try and make the best possible use of these investments available with us. And one thing for sure, I would say, try and remove the emotional trading part of it. Like we these days, especially these days, every other day there is a statement coming out from Trump, and markets suddenly react to it, right? So I would say before we start repositioning our portfolios every day or taking inverse positions in STI futures every other day, I think step back, hear yourself, and see whether it's just a noise or it's a trend, whether this would matter 6 months down the line or 3 months down the line, this news or this headline, and whether there is an actual need of reconfiguring your portfolio. If it is just a short-term headline, I think make use of STI futures to just use that and seize that opportunity. But if you really feel it's not just a trend or a noise and there is really a need of restructuring, use a mix of all of these assets to run your portfolios. And for now, I think this is it for today. If you do have any questions, like Minhoy initially told, you can post in your questions. I'll be very happy to answer them.
All right, thank you, Priyanka. We do have time for a couple of questions. So to everyone watching, do take this chance to send in any questions you may have about the Singapore market, and Priyanka will be sure to share her views and insights with you. We'll give you maybe a couple of seconds. All right, it seems that everyone has found the session very comprehensive, so allow me to get my screen up again so I can share with you an exclusive promotion we have in August. Yeah, so simply trade SGX STI Futures with Phillip Nova from now till 31st August for a chance to win prizes worth a total of $4,700, and it includes an Oppo Find N6 phone. You can trade SGX STI Futures with Phillip Nova at just 98 cents commission, and with every 3 lots you trade, earns you 1 entry into the lucky draw. You may scan the QR code on the screen to find out more. Right, okay. We do not have any questions. So with that, we have come to the end of the webinar. Thank you again, Priyanka, for the sharing, and thank you everybody for your time tuning into this webinar tonight. Feel free to send in your questions via the survey that will be popping up after these questions, and we will get back to you as soon as we can. We'll also be sending everyone a link to today's webinar recording so you can watch it again if you would like to. That's all for tonight. Thank you, everyone, and have a good night.
Thank you. Good night, everyone.